This is Trading New Lesson. In this lesson, we'll talk about chart patterns and technical analysis. Chart patterns are recognizable formation that appears on price charts as a result of historical price movements. Traders study these shapes because similar patterns in the mm, past often lead to similar future price behavior. In technical analysis, chart patterns help traders anticipate possible market directions, although they never guarantee an outcome. Chart patterns usually develop when an exciting um, trend begins to weaken, pause, or change direction. Because of this, they are considered an essential tool in technical analysis and should not be ignored. However, they should never be used on their own. For better accuracy, traders normally confirm chart patterns when other indicators such as volume, support and resistance level or momentum indicators. Broadly, chart patterns are grouped into three categories. The first one is continuation patterns, which suggest that the current trend is likely to continue after a brief pause. And the next one is reversal patterns, which indicate a possible change in the current trend. And the last one is bilateral patterns, which signal that price may move in either direction depending on market conditions. Below is a clear explanation of the major chart patterns covered in the slides. So this slide is about double and triple tops and bottoms. So double and triple tops and bottoms are classical reversal patterns that appear after a strong trend. The first one is a double top forms when price reaches a resistance level twice and fails to break above it. A triple top occurs when price tests the same resistance level three times. These repeated failures show that buying pressure is waking and sellers are starting to gain control. Once price breaks below the support level, or often called the neckline, it confirms a potential shift from an uptrend to downtrend. The next one is double and triple bottoms. So double and triple bottoms are the opposite of tops. They form when price touches a support level two or three times below it. This indicates that selling pressure is lessing strange when price moves above the resistance level. It signals a possible reversal from a downtrend to an uptrend. These patterns reflect a blind shift between buyers and sellers and often appears at important market uh, turning points. And the next important thing about this are is the um, heads and shoulders pattern. The head and shoulder patterns is a well-known um, bearish reversal pattern that usually forms after an uptrend. It consists of three peaks. The first peak is left shoulder, a higher peak is head and a lower peak is right shoulder. A support line known as neckline and also uh, connects the lows between these peaks. When price breaks below the neckline, it confirms the pattern and suggests that the uptrend is likely ending and a downtrend may begin. These patterns represent waking buying momentum and increasing selling pressure. In the next important thing is the inverted heads and shoulders pattern. The inverted heads and shoulders patterns is the bullish um, counterpart of the standard head and shoulders. It usually pairs after a downtrend and signals a possible upward reversal. It is made up to a low or left shoulder, a deeper low or head, and a higher low right shoulder. When price breaks above the neckline, it confirms that sellers are losing control and buyers are gaining strength. These patterns often make the transition from a bearish market to a bullish one. And the next important thing is um, symmetrical triangle pattern. The symmetrical pattern triangle is typically a continuation pattern, although it can also act as a bilateral patterns. It forms when price creates lower highs and higher lows, resulting in a triangle shape. This pattern shows a period of market consolidation where neither buyers nor sellers are in full control. As the range narrow, pressure builds until price eventually breaks out. The direction of the breakout determines the next trend. Traders usually wait for confirmation before ending a trade. And the next thing is about the uh, ascending triangle. An ascending triangle is generally a bullish continuation pattern. It forms when price makes higher lows while repeatedly testing a horizontal resistance level. This structure shows increasing buying pressure when price breaks above resistance. It often leads to further upward movement. And the next important thing is the uh, this descending triangle. A descending triangle is typically a bearish continuation pattern. It develops when price makes lower highs while testing a horizontal support level. This indicates growing selling pressure. A break below support usually signals further downside movement. Both patterns highlight a gradual build up of momentum before a breakout. And the next one is the rising wedge. A rising wedge forms when price moves upward within converging trend lines. despite raising price, momentum is waking, and this pattern is often considered bearish and may signal a potential downside reversal, and especially if it appears after an uptrend. And the next thing is, and also the most important thing is the falling wedge. So the falling wedge, yeah, yeah, falling wedge. A falling wedge forms when price moves downward with a narrowing trend line. Indicates weakening selling pressure and it often is often bullish. A breakout above the apparent trend line may signal a reversal to the upside. And the next thing is the ascending and descending and horizontal channel patterns. Channel patterns show price movement within parallel um, trend lines and or mainly continuation patterns. Ascending channel in an ascending channel price moves upward between two parallels lines. This reflect a controlled up trend where higher highs and higher lows are formed. And the next thing is the uh, channel. Descending channel shows price moving downward between parallel lines. It indicates a steady downtrend with lower highs and lower lows. In the horizontal channel is a horizontal channel forms when price move sideways between support and resistance level. This pattern suggests um, consolidation and a balance between buyers and sellers. Channels help traders identify potential buying and selling zones within an exciting trend. And then final note is about chart patterns are powerful tools for understanding market behavior, but they are not foolproof. Traders should always combine them with other forms of technical confirmation and proper risk management. When used correctly, chart patterns provide valuable insight into the trend, direction, momentum, and the potential price movement.